morning, I'm Christopher de Souza. I am with a office called Broadview Ventures. We're not your typical family office, but we are in the family office domain in the sense that we have a single LP, limited partner, out of Paris, the Ledoux Family Trust. So we are a combination of venture philanthropy, or rather philanthropy and venture. And so the way I describe it is we're a philanthropic for-profit venture firm. And while this may seem a lot of contradictions of them, let me just take it piece by piece. We are a venture company in the sense that we make investments, we do our diligence, we take an equity stake, we take a board seat as an observer, and we invest in companies. And we expect the companies to have a business plan that will produce a full-profit return, and hence the full-profit aspect of it. But we're philanthropic because our investments are very mission-based. First and foremost, we only invest in metabolic, cardiovascular. And to that extent, cardiovascular is fairly loosely defined. It includes neurovascular, which would be stroke. It includes metabolic, such complications and risk factors for cardiovascular, such as obesity, type 2 diabetes, dyslipidemia. So we cover a fairly broad spectrum, but it's only cardiovascular. We're also philanthropic because our investments are very mission-based. We're all about accelerating translation and helping companies get to a point where they're better poised or better positioned to raise that larger round. So it's kind of, the way I look at it is more gap funding. And the family is looking for more of a societal return and less of a financial return in terms of their investment. They want to be able to look back 10 years from now and say, here's all the money we've invested, and here's all the drugs and devices that are on the market today that are having an impact on the well-being and health and well-being of the patients. The family's been investing or has been in this space for a long time. Like most families, the cardiovascular focus comes from a long history of cardiovascular diseases across multiple generations. They first started funding academic research, now through what's become one of the most prestigious grants called the Transatlantic Networks of Excellence. They have given out $300 million to date in academic grants. But the genesis for Broadview Ventures comes from the fact that grants result in great publications and an advancement in the science, but it's not necessarily getting to the patient. And so Broadview Ventures was started in 2008. The first investment was in 2009. We only invest $1 million per company, and we can talk a little bit about what the criteria are a little later on. But we're a small team. We're based in Boston. Chris Galecki, who some of you may know, Brand Partners Research and Venture Licensing Group, is our managing director. The three of us directors, I come in with a pharma R&D background, having spent 10 years at Novartis, a couple of years at Sky Pharma in drug delivery. My other two colleagues are MDs by training. One has some background in cardiothoracic surgery, but spent most of the time in strategy consulting. My other colleague is coming through pharma, biotech, business development, was most recently a CEO of his own company. So we are the three directors, and then we have Nicole, who's up here, who's our office manager and keeps us all on track and coordinated.
Thank you. Please.
I'm Melissa Krauth. I am from a family office based in Dallas, Texas. The family office itself is called 2M Companies, and the chairman, whose family this derives from, is a gentleman whose name is Mort Meyerson. He was well known as a pioneer in technology at EDS and subsequently at Perot Systems. In that role, Mort actually was one of the pioneers of health IT, developing the first Medicare and Medicaid systems. So his kind of involvement in healthcare has gone way back, although in a different sector, obviously. Healthcare, particularly life science companies, has been an area of interest for the family for about 15 years now, and it started from from philanthropic donations, and then a recognition that of a desire to do more than just write a check for something, to play a more significant role in helping a company succeed and helping a technology come to the market. has become an area of increasing focus, I would say, over the last couple of years, and I joined them a year ago to head up the life science investment area. My background has been in life sciences always, originally as a strategy consultant to Big Pharma, then as an operating executive at a biotech company, and now on the finance side. We tend to look at companies at the early stage. We make investments of between $500,000 and $5 million per company. And for some companies, we play a very hands-on role, really an incubator, accelerator. I'm playing an interim CEO role on one company that we just formed with a great physician entrepreneur to get the company up and rolling. And when it's ready, we'll bring the right team in and have it operate on its own, up to something that's more limited. If the right team's in place and really what they need is capital, then we provide capital. We're interested in technologies tending to be kind of at the earlier stages. We're very valuation sensitive, and we'll look at a variety of different technologies in different therapeutic areas. But we have a particular interest in CNS disease and in therapeutics or high-impact devices, and less so in diagnostics.
Thank you.
Hi, my name is Todd Holmes. I'm a member of the investment team at Gurnet Capital. Gurnet Capital is not itself a family office, but it's the direct investment arm of a family office called Waypoint Capital, which is the family office of the Bertorelli family. As some of you may know, that's the family that used to own and operate Serono for 3 generations over 100 years and sold that business in 2007 to Merck KGaA. The family office really has a macro strategy of investing back into life sciences. They started that with a sister fund of ours called Ares Life Sciences out in Europe, and we recently launched and founded this fund in the beginning of 2014. The fund has a semi-hybrid strategy. We look at late-stage businesses, similar to what Serono was at one point, commercial products, revenue-generating companies with platforms that you can build from. The second side of it is this venture side, and that side is really focused on bridging the gap between what the family does on the foundation. They give grants, they give gifts to academic and research institutions in the life sciences, and what we do on the late-stage side. So we can invest anywhere from a $500,000 seed up to a $20–25 million series participation in a traditional venture round. We take a long-term investment approach, as likely do many family offices. So we look at our companies as individual companies as opposed to as part of a portfolio. So when we look to invest in a company in Series A, that's its own independent standalone business. When we look to invest in that company again in Series B, we're not holding dry powder. We're not thinking about what portion of this company takes up in our portfolio. We're thinking about that Series B as its own independent investment. The fund, as I said, soft launched in 2014. It's led by Paredones, who is the former CEO of Merck Serono US. My background, I've been in life science investing for the last 10 years or so. Have kind of run the gamut from public investing as part of a fundamental life science focused hedge fund through to my most recent position at Third Rock Ventures in the early stage venture kind of company creation side.
Thank you.
I'm Meredith Fisher. I work at a private office here in Boston that is held within a hedge fund. The hedge fund itself invests in fixed income arbitrage, so the work that's done there on the fund side is completely separate from the work that I do. What I focus on and what the partner that I work with focus on is direct investment of partners' personal capital, so it's private investments. We're not set up as sort of a fully structured family office in the way that some of the other members of the panel are here. These are direct investments that are made out of the partner's own personal wealth. And we do that sort of in syndicate with a specific interest in biotech and medtech investing. We started doing that sort of together as a group of partners and sort of a larger group of high net worth individuals in the Boston area in about 2008, largely because our sort of initial entrance into this area was as LPs in VC funds, so we continued to hold positions that way. But we started to see opportunities for direct investments, and if any of you guys recall, sort of the 2008-2009 years, you could get quite a significant amount of ownership for a very good price point at that time. That's what sort of brought us into that. And then over the past 7 or so years, we've been making on average about one significant investment per year, and have built up a portfolio of about 7 companies right now in the med tech and biotech space. We do not have an overarching thesis for how we do it, and I think it sounds similar to Todd in that we, although think about our companies at a portfolio level, individual investment decisions are driven really largely by the company itself and the round itself. We have historically invested sort of very early stage. We've come into seed rounds, and we have stayed with companies all the way out through G, I think, one of our companies are now.
G. Oh my God.
Yeah. A long backstory, as they always are, but have been historically stayed with the companies round after round. As I said, we don't have a very specific thesis, but really when it comes down to it, because the partners are writing personal checks, the opportunity itself has to both have an angle for return, obviously, because we are making direct investments, not in a philanthropic nature, but in a return-based nature, but also needs to align with an area that is impactful or exciting to them. So large unmet needs, novel mechanisms, things like that, where they really feel that the investment dollars at work are actually really pushing the envelope there. For things that are Me Too's or wonderful things, those are great, and they can be really great investments. But at the end of the day, for us, it's really driven with, do we think that there's a high reward potential here? That's great. We might be able to even say that's fine, even with the very, very high risk. But is the potential return also matched with the potential patient impact? And I think that's an important aspect to the way that we look at things, and how we use as a gating mechanism for the types of investments we do.
Thank you. Please.
Good morning, everyone. I am Alejandra Paredones, from the CEO and founder of BSI Capital Group, which we're based in Mexico City. I know we came a long way to this conference, and it's a privilege. Actually, I founded it's an investment bank which started 3 years ago, and sort of emerged into family office, multi-family office, where capital for my own and my family, our background is on wine and spirits and real estate. And then we integrated other family offices from Uruguay and Argentina. And actually a personal experience from us was most of my family and other partners were diagnosed with cancer, and we started having an interest on healthcare and biotechnology in the last 2 years, and therefore we launched 2 funds, one based in Luxembourg and one based in Mexico, BSI Genomics and New Global Holdings, to invest directly into growth stage companies. But now we're looking into investing more in early stage companies. And what we like about these companies is not just that they see us a long-term partner, but also when they start looking into global markets, especially Mexico, Latin America, that they can see that they can grow with us. So we like to see a CEO looking forward to maybe expanding the technology and the company eventually in the next 5-10 years into Mexico, Latin America, and that they can see us as a partner, because we have become a direct investor. But also what we have done is develop joint venture labs with them within the areas, and then we have the connections politically, economically to do it. So it's a whole cross-border approach that hasn't been truly developed, I think, in Mexico, and we want to become first players on the market, and we have done pretty well in the companies that we have invested.
Thank you very much. So you can see you're going to be in for a real treat in the next hour or so. Let me just briefly talk about how we're going to organize our time together and some of the things that we'll talk about in the next hour. First of all, we're going to have question and answers throughout the session, as opposed to the end. And we're going to go from the general to the very specific. You're going to learn a ton about how to interact with each of these people. So beginning with the most general, we'll talk about just why so many family offices have moved into direct investing in general. What are the macro trends that are perhaps driving that? We're going to talk about what type of life science company should actually consider approaching a family office. It's not for everyone. And then we're going to get really, really detailed with each one of these fine people about what their areas of interest are, when you approach them, how do you find them, what is the deal breaker in terms of interacting with them, how do you create a relationship with them, how do you need to be prepared to take advantage of the opportunities that they're offering, okay? So why have family offices moved into direct investing?
So, as I mentioned, we're a little bit of a hybrid. So the family has a trust that is invested for financial gain, partly through LPs and VCs, et cetera, et cetera. And what they're doing with the return from that trust is putting that strictly into philanthropic endeavors. So that's their way of giving to charity.
Okay.
Right, and so we and the Fondation Le Dieu, which is the grant-giving arm of the family trust, Broadview, which is the investing arm of the family trust, are all geared towards generating in some way or another an impact on patient life. So if we make money, that's fine, but we're not.
Would that make them less inclined to allocate a share to a venture fund or something and invest that way?
No, because that trust is being invested. Like
so
any trust is invested.
You're taking advantage of both.
Correct.
Yeah.
So we are just basically using, all charities are required to spend, or all family trusts are required to spend a certain amount of their return every year, and we're spending that money.
So that might be the motivation for your particular trust, but could you comment on the overall trend about, have you seen more family offices enter this space?
Yeah, we have.
And why do you think that's the case?
So without having direct experience, my understanding is that rather than put the money into the VCs, they'd rather spend that money, they'd rather invest that money and have a direct say in who that gets invested in based on what the family is most interested, but there are more people who do lots of.
So maybe more control, please,
I'll pick
Meredith.
up from there. I think that's actually, Chris's point is a good one. You know, the partners I work for are traders. You know, a significant amount of their own personal wealth is in the fund, and so, you know, they essentially operate and control the majority of their, you know, of their own net worth. You know, they wanted to get into biotech. A way to do that was through becoming an LP in a venture fund. But, you know, because they're so used to operating with their own capital, you know, the word fee is not one that they're particularly excited about. And, you know, exactly the point. You know, when you make those directs, if you can do that in a large enough way that you do have control. For instance, we have a board seat or observer seat on every company that is in our portfolio. You know, there's a degree of oversight and, you know, control. We can talk about control at some other point. I think the other thing that's been interesting to me, at least in the last year or so, is that I've seen, or we've had more family offices reach out to us who become interested in biotech, and they heard that we do some of this. And I think at least the feedback I've seen there, or the reasoning there, has been the biotech IPO market got really hot, and guys were doing well there. And so then they want to start to think about where else can we be putting capital to work that might be a couple steps back. So I'd even qualify that to say that what I've seen, at least in my own observations, is that that's been of interest, but they're really interested in the later stage crossover. Like, they missed this IPO, but they're looking for the next two guys that look just like that need a late stage bump up round and then are going to go public, which is for us a little bit different than the way that we've approached it, which has actually been to put early stage capital to work. Hence, you know, we're out to Series G in some of our companies. You know, which is a little bit of a different mindset and approach to it. Although certainly, this last year has made us also stop and think, well, do we want to be looking at some late stage stuff as well as part of the investments that we're making? And that's an ongoing, you know, question for us.
I'm sure everyone in this room would love to know the names and addresses of the people that contacted you, but I won't put you on the spot. Other reflections on why this is a trend?
Having participated in a venture fundraise, so going out raising from limited partners, it's very clear the world of these limited partners, the foundations, the endowments, the fund of funds, don't see venture capital healthcare focus, especially life science, biotech, venture capital is a great return on their investment. It takes a lot longer. Returns historically have not been good. In most cases, if you're not in the top 10%, you're losing. You're getting less than a 1x. There have been very few years, very few vintages where that's actually been an anomaly. The common message that I heard during that process was, we are going to pick one fund, and we're going to pick that fund, and we're going to stick with that fund. When you think about a family office, their ability in many cases to get into those top funds is very limited. And so with that knowledge, they're thinking, why should I go invest and knowingly get a 1x or get a half x on 10 to 12 years of an investment, when I could perhaps make direct investments, not pay the fees, and potentially see a better return over a shorter period of time.
So can I ask you a question about that? So do you think that they approach this with the feeling that they actually can pick a company, a high potential company on their own that will do well? They're not afraid of the 1x's that most people get?
I think the return...
I mean, there's something special going on here.
The return on finding somebody to help you pick that investment. So what do you pay a manager, a direct manager?
Fair enough. So they're dedicated to the space, but they're looking for a more efficient way to...
Exactly.
Okay.
You know, I'd also add to that, so I completely agree that the fees and, you know, the desire not to pay those is important. I think it's also just personally interesting, right? And you know, that falls on something that Meredith said originally, is this is, you know, it's an intellectually interesting area that you can feel good about having made your investments. They're not always going to pan out, but right, if you invest in big ideas that have a goal of ultimately helping patients, then that kind of ticks multiple boxes besides the financial.
Are you seeing more people interested in, more family offices interested in doing what you're saying? Is that a trend, or are we making that up to get a lot of people to this panel?
You know, it's difficult for me to say because I'm fairly new to the family office world.
Well, even
but
more
I
so.
will say that we regularly encounter other family offices that express an interest.
So there's hunting going on
in working with us and sharing deals.
Okay.
How much of this family office investment is financial, and how much of it is societal or mission? When you're looking at it and you're making a selection.
You know, for myself, I adhere to a quadruple bottom line for our company. So
do all of them.
You have to do all of them. It has to be a good financial investment. It's not philanthropic in that nature, but it has to go beyond that. It has to be you know, good for patients, good for the employees of the company and for the employees of our office, and produce some good for the community. That's what I'm held to.
Do you have anything to add about the trend and whether it's real or?
I mean, it's real.
Real?
It's actually hitting south of the border, where, you know, other family offices in Mexico find out what we're doing, and they want to partner up with us in terms of the pre-IPO opportunities, and that's something unheard of. Wasn't heard of in Mexico, and they wanted to know what we were doing and how we're being successful. But at the same time, you know, it takes also a social approach from us, because we're actually doing well by doing good. In that sense, that we're actually helping companies grow, but at the same time, it's having this positive impact. And that's why we're trying to get more involved with companies in this area.
Do you think, someone mentioned the IPO burst, do you think that the family offices are committed to watching that bubble burst or kind of tail off a little bit? The reason I ask is because just being on the ground and seeing the number of companies, at least in Boston, looking to join us, which is a vehicle to get funding. I think we had like, in the last year we had like 52 inquiries. We could only accept one company. So it's pretty easy to pick winners. But the National Institutes of Health money has just been awash in the city for 20 years. And there are, and the way the federal government is encouraging more translational research, I just see the deal flow increasing exponentially. And so the trick is, how does it match with the macro trends that are going on in the market? So our family office is committed enough to continue looking at that burst of deal flow that's coming in. Sounds like you are. Sounds like you're pretty bullish on this, regardless of what the market does.
I think it's going to depend on each office and what their individual motivations are.
Okay.
You know, I think for ours it is a long-term commitment.
Okay.
Because it's not driven entirely by, you know, I see I'm chasing where I see the financial gains, and it's going to change every month. But I'm sure there are others that are more chasing that, and yeah, they probably are more volatile.
I'm probably more, I guess, apt to hope that burst ends at some point. And when that ends, and we've all seen the cycles, 3 cycles over the last 10 or 12 years, then our choice becomes that much. We have the luxury of sitting in a family office and having patient capital, long-term investors who aren't sitting on this. You know, you have to exit within 3 to 5 years. We can wait a couple years. We can wait for capital to become scarce, debt to become more expensive, IPO markets to close. That is a good thing from a financial return. Obviously, not good for developing new medicines, new treatments for patients. But perhaps a kind of a watchful eye on valuations as you're making your investment decisions.
Are you ready to invest in early? What is early in diagnostics or therapeutics that you may look at?
Yeah, so I can speak from at least just the perspective I think that we have, which is, we are not a group that is going to be able to build your company for you. Mm-hmm. So if you are a PI at Harvard, that's great. You might have something really terrific. We're not necessarily going to come in and give you $500,000, $2 million, or whatever amount of money for you to actually fill that team out and be and sort of be with you and a partner in that. It's just not. We're not even just you're looking at the single employee on the side, right? So while I might love to do that, it's just not something that's actually we have the ability to. That said, early, if there is a technology, that there's an executed license, and there's a team or the start of a team around that, that could be a very exciting time for us to get in, where we can rely largely on the team to that we think can operate and execute, but still has a lot of stuff to work on the technology. That can be absolutely fine, and that's a point where we could potentially engage. Again, just that's our view. I think you guys. It sounds like Melissa and others may have a different view of what's early and what they can when they can really come in.
Go ahead, please.
So for us, we won't invest earlier than, so let's put it this way. We need to see what the money's going to be used for, because remember, we're only investing $1 million. We don't follow on, we don't go into the next round. So we only invest $1 million, and what we need to know is what is that $1 million going to be used for? How are the deliverables going to help you increase your probability of raising your next round? So how are you going to help? How's that $1 million going to help you cover the gap? And who do you have on your team that's going to give us the comfort that they have all of the know-how and necessary skills and capabilities to deliver on that investment? And that doesn't mean that they have to be full-time employees of the company. They can be consultants. They can be on the advisory board. But a lot of our early-stage companies are pretty virtual, 1 or 2 people. But they've got the right set of team. Now, the way we make our investments, we're doing it 3 times a year, and we take everything that comes in before an investment point, and we take the best of what we see. That said, for us now, the early part is becoming first in man, because to your point, Bill, NIH has done such an incredible job through the SBIRs, etc., of funding and helping companies get their development move forward. We have assets, we have companies now that are in phase 2 that $1 million from us is
phase 2 of SBIR.
No. Phase 1, phase 2 clinic.
Oh my God.
Which have gotten to that point with SBIR money.
Oh, that's amazing.
Right, and that $1 million
wow.
is with the private money that they need to bring to. So our process is very competitive. I don't think a lead optimization stage company would make it to the top 3 for our advisory board meeting. But from a minimum point, we need to know what are you going to use the money for, how those deliverables will help you raise your next round, and that you have the right team involved.
Do you do it solely, or do you prefer to have other co-investors, family office level?
We personally, as we're quite new in the space, we prefer to we have a co-investor, because also that minimizes risk for us, and also that adds the smart money that we're looking for. I mean, we're looking into a long-term approach, and we also like to see the other co-investor going a long-term view, because sometimes for us, when I see a VC doing a term sheet of $20 million for a company, for us it's not attractive. I don't see them as a co-investor because we have a completely different view. But when it's two family office or a high net worth individual, then it changes and that becomes attractive for us.
Do you make a point to create a syndicate, so to speak, or do you kind of let the founder, or both?
It really depends on the situation. We review it, but we let the founder sort of make a decision about creating a syndicate or not.
Other responses to that question about
We've done both.
co-investment?
If we see an opportunity that we think is very compelling, and we think that the amount of capital that we can invest can take them to a very clear yes or no, then we're willing to do that by ourselves. It can kind of simplify things and speed things up, and we'll know. If we think that there's a reasonable likelihood that you'll get some somewhat ambiguous and you could hit some delays, we definitely prefer to have other folks in the boat with us in case we need it.
Family offices are a little bit more mysterious. How do we find other family offices that have some of the same parameters?
The standard answer is networking, right, which is not terribly helpful.
Well, with whom, though? I mean,
right.
She's in Mexico.
Right.
I think we like our privacy, but the networking, for instance, I started in the U.S., and professors, our legal, our accountant, etc. They're actually are really good sources for us to also find investments, but you have to use your different resources. If you don't have the network, maybe your patent lawyer might have that network and might know some of those family offices because they're actually the lawyers.
Investment advisors also a great source. So there's one here in Boston. We actually have space with Cambridge Associates.
Sure.
They do a lot. And there are more and more family office related conferences coming up. I don't know how you define family office, right? But part of my job is I'm out of there saying, hey, we're here, please come to a conference.
So you're eager.
Yeah,
you don't want to be bothered, but you're eager for the contact.
And it's very clear. We're only cardiovascular. So if it's not cardiovascular, we won't be interested, right? So now we've almost tripled our info. We saw over 500 proposals by the end of August. But we're actively looking for them. But I don't know. Some families may want to keep their privacy. I would say
advocacy groups and key opinion leaders in the field will often have families that have funded them philanthropically, right? And that's, our first deals evolved from a philanthropic relationship with the university and with the investigators.
So the $20 million Series A that I talked about, that was a referral from the, the Muscular Dystrophy Association, who obviously had their eye on this family office for philanthropic reasons as well. Great idea. Any other comments about how we find you?
I guess now that I'm new to the family office space, I really don't have any good suggestions, but I will say that
Well, how did you find it?
They found me.
Aha!
So I actually had limited background with the family. Embarrassingly, didn't know that was the family behind Serrano, but
fair enough.
But they've established these connections with academic institutions for that reason, and so you have kind of gifts and philanthropic grants, and those have been the key source for us just internally. We have not been very public. In fact, we have not said anything about the fund until today, really, and that's where the majority of our deal flow has come. So the academic kind of relationships through universities where these innovations likely come from, those are kind of the key source for us. Because we can't be active. We have a small team like most of the folks here.
I think the takeaway, though, for me is that while we respect your privacy, you are actively looking for opportunities, and people will know about that in your networks, hopefully.
How do you look to build a relationship, and what do you value in a relationship?
honesty factor. So I think you see this. I've seen this on again through the gamut of public to private. There's a lot of these, and I believe we'll probably talk about pitches, quick pitches, and this is really hot, this is a really hot company. I think just being completely open with what's happening with the company. Where are you struggling? What's the areas of need? What are you executing against? And there's that kind of trust. It's a lot of times you're selling a company on a tell me story. But really, what it is in these relationships is a show me. So tell us kind of what's going on with the company. Keep in touch. Be very clear with how you're financing, and if it's hard if you haven't been able to finance, you've been rejected by all the venture capitalists. That's fine. That doesn't affect the way I think about a company at all. In fact, it probably says maybe somebody's missing something. As soon as you start to see that kind of shift, there's a little bit of that trust lost, and it's really tough to recover from that. So I'd say that.
Please.
Also, being genuine. From the beginning, especially when someone is approaching a family office or an investor, they're happy. It's a honeymoon stage, and then you make the investment, because this has happened to us, and then after that, the honeymoon phase ends, and there's this block, and there's not the emails or the calls. So we like to see, a company, a CEO, and a founder as a friend of us. And not just, and that's sort of the honesty factor, you're not just looking at us for the money, but also looking at us to be a friend, that we can take you golfing or play tennis, but that part for us is very important.
The family office that did the $20 million Series A that I talked about actually supplied a couple of missing pieces to the team. That's part of the deal,
I hate to say this, but you're investing in people, right, at the end of the day. I mean, you have the best technology, but you don't have the right stuff. People support is never going to go anywhere. But the fact that you're looking for money means you've got a series of problems that need to be solved. And just being open and honest about what those problems are, how you're going to address it if it's not solved, and being aware of what's out of there and what challenges you face. To a large extent for us, it comes down to that first conversation. I mean, if we don't feel that the person pitching has a good grasp of what's going on, it's not going anywhere.
So I'd pick up on that a little bit, and I'm not sure if you were talking about company and family office or just network. So it's
company
not company. Okay, so I think the other thing that I would say is, and I have experienced this several times, where I've gone to a meeting and the person who was pitching me was surprised that I had read background papers and was going to ask them scientific questions and displayed some degree of actual knowledge and expertise in the area of which they were pitching, because there's a little bit of a twist of like, oh, this is a bunch of traders who just think they want to write some big checks, and at the end of the day, the partners that I work for are very sophisticated traders who are willing to write checks, but we do a full diligence process. I am trained as a scientist. If I'm coming to you to talk, I actually want you to talk to me, exactly to Bruce's point, about the science that you're doing, about the warts of it, and not think that you can sort of Jedi mind trick me to say, oh, this is great, because you think that at some level there isn't a degree of sophistication. I certainly am not an expert in everything, but I will prepare. If I'm taking a meeting with you, I will prepare for that meeting as well, such that you should be prepared to talk to speak that way. And so that, for me, I've had a few of those where I got to tell you, 2 minutes in, it was over. I might have stayed with them for another half hour or so, but that was not. That was not a good start to the conversation.
When you get past the front meeting, right, and the relationship seems fine. Where I've seen relationships kind of take a digger is when I start to ask those very difficult questions and put that in writing for me and get back a little bit. How you respond to those difficult questions says more to me than anything else. If the science is great, but you don't like to be questioned, then we know it's not going to work.
So the pattern emerging is that these folks will operate as they are, sophisticated investors who will be every bit as tough, and maybe tougher, since they're going to be with you for the long term.
just to clarify, so we're making about 4 investments a year, but this year we may be more than that. It's just the way the process works. We're seeing a lot more because I've been out on the road a lot more and getting the word out that we're making investments. But because we are unencumbered by the need to make money, we can take a lot of risk, and that's really where we're going. We're trying to de-risk programs so that they are amenable or better positioned for other investors to come in. So typically, we won't invest in Me Too, we won't invest in repositioning, we won't invest in healthcare IT. So a lot of that sort of stuff, we're taking some pretty big risks, and so to that extent, we can very quickly hone in on about 15, 16 companies, which will take into initial diligence, 6 into full diligence, and then 3 go to our advisory board 3 times a year. So if you think 2 companies at each advisory board, that's 6 a year.
Question was about the number of investments these folks make and the difficulty of finding them and how selective they are. And is it worth trying to approach them? But the ratios I'm hearing are very typical of any investor. I don't see that they're any different. They might be. You all might do 1 or 2, but most funds won't do more than several a year anyway.
What kind of stakes do you take in early stage companies for financial investment? Do you take board seats?
Do you mind if I'm going to give you a little cover? So based on my experience, you can expect to get as diluted with these folks as you will with any investor. And that's the way to think about this. How about that cover? Good? Okay, good. Go for it.
We generally expect, if our investment size is of sufficient, portion of the round, that a board seat or an observer seat would be made available to us. So if we're going to give you a small amount of money, it's not reasonable for us to expect to have, play a role in the board. But if we are putting multiple millions of dollars into a round, our position is that is a reasonable expectation. We also understand that over the course of the lifetime of a company, the board composition changes, the investor set may change, and you need to be able to move with the tides. But that's generally been our position to date.
Other comments on that? Observations?
Consistent for us. We're given that we're a new fund, we're still in relationship building mode, and we know that we cannot handle likely over a 3 to 5 year period all of the board seats that we would need in order to cover the investments that we make. And so for us, it's all about trusting co-investors who we've grown to kind of develop a relationship with as well. So I think we'll see a mix for our fund.
We only take a board observer seat.
Yep.
And we take on every single investment we make, we take a board observer seat because we want to be aware and know what's going on. That said, my colleagues and I spend about 60% of our time working with our portfolio companies. We're either helping them raise money, I'm de facto CBO for one of my portfolio companies, or we're working with them on other aspects, advising them. So we spend a lot of time with our early stage portfolio companies.
We're probably unusual. We don't do notes. We do preferred.
Same here. I think we would prefer to set the valuation ourselves.
We have and we do participate in notes. Largely that has been with a cap on them that we think sets, that sets sort of in tune with the market. I would say that maybe just to take that one step further, and perhaps we'll get into this a little bit, but we see some really great deal opportunities that for us we'd love to get our hands on sort of before the VCs do, because we think that this is a early stage company that probably will attract venture capital. One of the challenges for us is to have a group of VCs include someone like ourselves in that syndicate. It's just not something that is, we're not calling up Third Rock and saying, hey, let us in. And so one of the ways that we can get access to those types of companies is by being a little bit early, taking a position as a note with the expectation that that will convert into a venture-led round And so that's one potential strategy. It's not the only one that we take. We always sit and want preferred, and we certainly participate in rounds as well, but is something that we have done.
Our goal is to get companies up and running. We're all PhDs, MDs. We don't do valuations. If there's no valuation on the table, we'll do a convertible note, and we agree to convert at the next qualified financing. If there's equity, we buy the equity and we're up and running.
Just curious to hear your thoughts on now that nonprofits that are disease focused. I was just wondering where that is in your interest level.
We've looked at a couple of it depends on how the economics work, right? Because of having the dual bottom line, certainly those opportunities satisfy one portion of it, but you have to make sure that somehow the finances are aligned.
Would you consider something like that?
The foundation that the family has, they make those decisions whether to invest in particular areas and patient advocacy groups. When you get into, is there a compound or is there a program of interest? Certainly, if it's in an area of interest for the family, if it's an area of interest for us, that's something we can think about. But primarily, we're concerned about who's making decisions. How quickly can you progress it? Is it a good financial investment? Again, outside the foundation, we have to think about those things.
And what's the best vehicle for that?
Exactly. Yeah. Is it outside?
We're seeing a lot of deals now where people are using the public markets for classic fundraising as opposed to liquidity, or that's an opportunity.
Yeah, we can figure it out. I think it's not beyond a solution. The issue that maybe some of us are not as equipped to handle is the evaluation of the public markets in general. So as opposed to taking purely scientific risk or execution risk, now we're taking on public markets and macroeconomic risk. So those sorts of things. There are a number of family offices, I believe, that are kind of more generalist focused that have a public trader or somebody that has been in the public space for a while that can kind of handle that. The liquidity aspect is attractive. But again, we're all long-term focused, so that's not high on the list. I don't mean to speak for everybody when they do this.
Oh, you're absolutely right. I mean, we're impact investors, so if they're already at C and D, it's too late for us. And what are they going to do with $1 million from us? Very little. So we stay away from that end.
You should go raise if you can get in the public markets. At this point, yeah, go do it. Worry about family offices.
3 questions for the home stretch. All right, you ready? How do you feel about being approached through third parties that you don't know, investment bankers?
I would pick up and say that comes a little bit back to the conversation we were having earlier about relationships. We actually do have and have started to forge some relationships with some investment bankers. So that comes down to whether we actually like that person or not, whether we think that they are, so I met with an investment banker recently. It was the first meeting, and, it went well, I think, because exactly what the conversation was earlier, where basically said, here's what the company really should be valued, and here's the warts, here's the problem, here's the entire backstory. This is why they're at this valuation, this is what's happened, these are all the bad things, and here's the real opportunity. Like, maybe that's a match for you, maybe it's not. And I think that that was, and actually it's not a match for us, but I appreciated that. I felt like there was at least, honesty and openness there in that conversation, because that means that the next time that he wants to come and talk to me about something, I'm probably more likely to take a meeting. Whether or not we'll do anything with them, we'll see, but I also think that also comes back to them doing that relationship over time.
So it sounds like you don't mind the relationship if it's matching.
Yeah, right.
But how do you feel about the fee that sits there? Come on. If it's a good deal, does it matter to you?
If it's a good deal, it doesn't matter, because the fee at that point in time for that financing, if we're coming in, we're expecting that is just going to be a rounding error for what we're going to see on the other side of it.
So you're investing for the long success.
Right. So I think that's, preferred not, but if we think the deal is good.
So the first one maybe has to be free, and then the next one. Please, you had try it. Good luck. Good luck with that.
Yeah, exactly.
And within our practice, we actually do have we manage an investment bank as well. And having that background, so I'm an investment banker too, but just in Mexico. I see that companies, I would take a company more seriously at times because they have an experienced negotiator as well on the table, whereas you have a PhD or MD that doesn't really know about finance. And so when I'm dealing with an investment banker, then we're talking business. So for us, I take it a little bit more seriously when you have a certain banker at the table. So I actually like it more.
Okay, this is good. Other perspectives?
So I completely agree with that. On the other hand, I've had investment bankers pitch me things that they don't understand the story as well as I can't get my questions answered, and I think entrepreneurs show you their passion and understanding in a way that you don't get from a slick banker pitch. So there's pros and cons of either approach.
I think you want to answer this question. Take a stab at it.
No investment banker is going to work for raising $1 million or $2 million, so we don't really see them at that point in time.
Well, there are third-party high net worth individuals who will have like a little consulting firm. They may have cashed out. I've seen it happen. They're good for $1 million or $2 million. They're around.
So if they come
but do you want to be
us,
approached by someone like that? That's the question.
We won't turn them down. We'll look at it, but at the end of the day, we're going to go talk to the company. Because that's really where we're coming in. We want to know that they understand what they're getting into, they know what the deliverables are, they know how we're going to use our money. We have a lot of investment bankers working for our portfolio companies that are trying to raise, 15, 20 million, 30 million, and they're opening doors, but even then, the teams are still out of that going to pitch.
Yeah. So how important is it to have my branding in order, my website with people on it?
It has, if the company is truly, a couple scientists and you effectively have to put the team together around it, then it's expected that they haven't, spent the time doing that.
Right.
But if a company, does have a professional CEO on board and they present materials in front of me that are just plain sloppy, and I've had that happen more than once.
Well, what's sloppy? Typos or just starting off talking about something that would take you a week to figure out?
I've just seen horror stories in anything, right?
Okay.
With really, really cheesy graphics and typos and not telling a clear story, right? Then that tells you that the thinking isn't quite as clear and the attention to detail isn't there. I don't need something, I don't want someone to have spent a huge amount of time and money in the early days developing really, really slick materials, but a level of professionalism or a lack of professionalism that gets you kind of screened out.
Well, let me try it this way. We all get inquiries, so the first thing I do is I Google. Is that what you do?
No.
You've got a different viewpoint.
I don't know if this is, it's not a complete counterindicator for me, but I think it represents where the team is focused. So if it's the, I think this is similar to your comment. For me, I'm looking at the story. I'm looking at, does this business plan make sense? Does it, from the, I look at just the slide deck usually. So from the first slide to the end to the last slide, do I get it? And does it so does it show that the thought has been put into it? Have you done your research? Have you gone out and found the right data? Are you referencing data from 1997? Those sorts of things. It all goes into what you're actually telling me, as opposed to me finding a really interactive website or seeing a really pretty slide deck.
So that kind of assumes that you've heard some sort of an introductory pitch, either in person or through a referral. So but the story you have to want to say, I want to learn more about this, and the deck has to treat you in terms of me as a founder understanding what you're actually looking for.
Yeah, I would say also that we see a lot of decks that are sent to us that are appropriate levels of detail and look really nice when someone's talking you through it, but the company should have a deck that has enough detail such that if I went through 10, 15, not more than 20 slides, do not send me 50 slides, you know, and I could read the titles of those and had, you know, some sort of conclusion at the bottom, even if I just, you know, spent 3 minutes and read the title and read the conclusion, I knew the full story, and if there was enough information there that it actually told it. You know, I understand that everyone always prefers to get on the phone or get in front of you. That's great, but that's just not always going to be the opportunity that you have.
So
and
can I push back at you?
Yeah.
So you're intriguing to me as a founder. I give you a deck, you're going to find the one thing in that deck you don't like, and you're going to pass me by because you have so many other opportunities. I do want to see you.
Sure.
And that's what these people are thinking.
Absolutely, you want to see me, and I may want to see you, but I just may not have time in the next month or 2 months to do that. So if you have a chance,
is just
right. Put something in front of me. Does that do not, you know? I think actually I would even actually just at this conference, and maybe it sounds a little too critical, but you know, on the partnering website, the number of people that use the word innovative, novel, you know, the first line, it was almost like we have the most innovative, novel, disruptive technology of X.
They do.
It's like you know, you see 50 of those, right? So I think it goes even more beyond that, which is like tell the direct story about the company and what you're doing, what problem you're solving.
And why this is a great opportunity now.
Right.
What is the wave building that you may not know about that this person sees?
So anyway, maybe that's my own personal view.
Other comments about websites or fancy profiles on Google or whatever? Please.
Well, it has to go along the way that you present materials and yourself, and also the kinds of emails. I mean, I receive at least 200, 500 emails per day, and the email, the way that that's your initial, at least for me, that's your initial presentation. So if the email states, as you know, and then starts telling me all these fancy medical terms, then I'm not going to look into the presentation. So you want to be approached in a friendly way, and then I will look into the presentation. But for me, the first moment is the email. So
can you give an example of a nice email? Everyone will copy it, but seriously. Hey, I understand that you're going to be in the States. We should get together in Boston.
Yeah, for instance, I understand you're coming to the conference. I do a little bit of background, maybe on myself and what I am investing. It's not, if I'm investing in genomics per se, then that area is a huge interest for me. So basically know a little bit more about me and think of me as a friend. So I prefer that instead of having an executive summary in the email, and then I say, what is this, right? So.
And you probably shouldn't see the MailChimp logo at the bottom of the email message, right? Right. Other comments about that?
A couple of things. I've seen emails coming to me, and we're a cardiovascular company. You don't really have to spend 15 slides on telling me how big the market is. It's intuitive. And Meredith's point is really right. I mean, your title should say, here's what we're doing and how we're doing it. The title should tell you, give you the punchline of that slide, and here's what the state of the industry is. Here's our technology. Here's how we're solving it. Or here's what we've solved, and here's how we solved. 10 slides. I mean, and people very important. Right? And that's it. But enough to whet my appetite to say, I want to learn more about this. This is very interesting. And don't send me an oncology slide because I'm never going to call you back.
Oh, I know that. But we say hi in the hallway.
But you'd be surprised. I mean, I came from the sales side, and being on the sales side is very difficult to get people's attention. So I try to always respond to everyone who sends me a partnering request, even if it's from an oncology company or an infectious diseases company. But that's 80% of what I'm getting is from them. People are not doing their homework.
Not a bad way to think about this, but you're actually all learning all the time. You're also looking for the wave. So I approach you. I'm going to teach you. I'm going to inform you what I have seen, and you probably will read. You may not invest, but you will. And this person really helped me out.
You may also want advice, and not that I should be giving anybody advice, especially on the science side, but it's also good to establish, it's not again, it's kind of maybe going back to the relationship thing. Like, let's talk about my company. What do you think would help me kind of get in the door in these places, or, what are my financing alternatives, those sorts of things. At least, people love giving advice. It's probably why we're sitting here today. It's an easy way of kind of interacting and maybe a non-sort of salesy.
So are there things we should be looking for that would allow us to go on to more productive discussion?
I think one of the things that I don't find that entrepreneurs do well, that I end up actually doing a lot, and sometimes I appreciate, because prior to this role, I had business development for a small startup, so I have been on the other side of like just cold emailing random people at big companies trying to get them on the phone, right? So I've sat, just recently on the other side, and one of the things I learned there, and I end up actually doing a lot in meetings, is telling them what our process looks like, what I think the next steps are, and I think that I realize that it's a little bit of a shifted dynamic, because I'm the person that is sort of standing in front of the piles of capital that you want to get access to, and so people tread a little bit lightly. But I like to see someone say, okay, and so what did you either think of this meeting, or what would you propose next steps would be? Here's what I think it would be. It's because one of the other things we see even with our portfolio companies when they're out fundraising is that there is a disconnect. They think that any minute this VC or this strategic or someone is going to hand them this golden term sheet, and it just doesn't come, because it's very hard. And so I think entrepreneurs should not be afraid to ask questions of the investors that they're interacting with to try to drive some of that transparency. And at least for me, I end up trying to sort of offer that to as much extent as I can, simply because oftentimes they don't ask. So.
Yes, and to add to the point, and going back into the way that companies should be presenting to investors as well, we don't give out too much information about ourselves. I mean, there's enough. The public, you can Google BSI Capital, is pretty easy, and who they're involved. But at the same time, we expect the CEO and the founder to be asking the questions: where the money comes from, who are the shareholders of BSI Capital, how many investment funds. So those questions sometimes are being asked by the investment banker that's structuring the deal. So that's why we see that level of sophistication in a way. But we're very clear in terms of our processes. We're very clear, this is what's going to happen. If you don't have this, then we're not going to invest. And sometimes there has to be a level of expectations met, middle ground. And but at the same time, we like to be, we're very straightforward and straight to the point.
I'd like to think that we are, we have our clear process and things are very clear, but in our family office, in other family offices, you just find it's the territory. You're dealing with often people who make decisions, and those things happen for them. And when decisions go up to the decision makers, which are often sometimes the families themselves, the patriarch, the investment committee, they can take their time, and there's no rush. And so, as part of a direct investment firm for a family, we're kind of a middle person, trying to manage that as well. And I think what you can ask for maybe up front is, if the process is going to take a while, please let me know. Those sorts of things, because we're trying to facilitate on our end as well. And ultimately, we have a boss, and that person will likely decide when they're ready to decide. And sometimes you have committee meetings that are every 3 or 4 months. You may just miss the cycle, and you have to wait.
Perspectives? Anything to add on that? Otherwise,
I think it's there's a limited amount of money, and there are a lot of people vying for that money. So obviously, you'll take what you can get, but entrepreneurs need to do their diligence too, because if you're uncomfortable with VC or with an investor, you're probably right. The government is right. Just as if we're uncomfortable with an entrepreneur, we're not going to invest. You're probably right. And I think, and they'll come back to bite you later on with the term sheet, and you're already in discussions, and you spend a lot of time. So you need to do your diligence too. Talk to people who received investments from those folks.
Do you ever assess it, Dennis? I mean, do you come to us and say, we'd like to have a meeting with you, or you just get so many requests? And then the other question is that if I get a no response, which happens a lot, whether it's this conference or another one. I don't know if you were just inundated.
Do you ever do you ever go over the attendees list and find this gentleman?
Well, I've actually gone after a couple of companies.
Okay.
In fact, we've invested in one that was already phase 2 and very tight budgets. Very key area for us in stroke. And we said, we'll come in and we'll give you more money and so you can expand your recruitment. I do go through the attendee list and see who's there. Because if you're cardiovascular, I want to definitely talk to you. But I have limited time at the meeting, so I cheat and I send out things and say, talk to me outside, so I can use this meeting to network into the community. So I do, we are as a team proactive. And oftentimes not often, but when people ask us, why did you say no? Can you give me some insight? We're happy to take a forward to the extent time is available.
Because it could be that there's another application of the technology that they're thinking of, and maybe they should have been more straightforward about the pitch deck, but there might be a blockbuster sitting there. Yeah. There might be an application in clinical trial informatics or something. And so it's not, I would recommend it without being a pest.
So I probably shouldn't say this, but if you've been contacting me and we're contacting you, it might be for another deal. Might be doing diligence on another technology, and we're looking around. So that's something, as companies, you have people who find you. They're either running a dedicated process, or they found you for perhaps other reasons. On your question as to kind of how we respond, I think we strive to respond to everybody and be a good partner in this ecosystem. Right? We don't want to waste your time, and we appreciate the inquiry and sending us your plan and the opportunity to invest. But we are a small team, and sometimes we may sit down once a month, once every 3 months, and get to those plans, and it might take some time. But I think all of us should hopefully strive to that as well, even though we do get upwards of 500 to 1,000 plans a year.
Might be right. I think I probably get to 98%. But there's 2% that do slip through that I just, because of bandwidth, don't have. And so I think, a gentle, polite reminder is a nice thing. I also, know some colleagues that have, not at my firm, but others that actually have a non-response policy. So they kind of don't, if they're not going to take action, they don't do it. So you kind of need to, if you don't hear back after a nice, a follow-up, then perhaps they fall into that bucket.
And the best answer for us is, other than a yes, is a no.
Right, exactly. Clarity's good.
Or not yet.
So we have run out of time. So thank you very much, and thank you. It was a really